Alright, let's start out with robustness. Do the definition of it. Robustness or robust is a characteristic describing a model's, or in our case, an expert advisor's, ability to effectively perform while its variables or assumptions are altered. A robust concept can operate without failure under a variety of conditions, such as market conditions. So a robust strategy basically can handle a changing market, which means it lasts longer. If your strategy blows up after a couple of months, it isn't robust. It was over-optimized. What is optimization? Optimizing basically means that you are fitting your strategy to data. You're tinkering with, let's say, moving averages, changing it from 21 to 22. Both of those I'll consider an over-optimization. If your strategy works with a 21 moving average, but it doesn't work with a 22 moving average, it's not robust. A robust strategy, moving average strategy, should work with a 21 moving average, a 20 moving average, and a 22 moving average without much of a difference. If it has a big difference between those three numbers, it's not very robust and it shouldn't be used. And in a sense, actually, optimization is kind of a contradiction of robustness, because robustness is saying that it can operate with a variety of parameters, and what we're doing with optimization is we're removing a variety of parameters and we're finding the best one to work in our data. And if we use too little data, it's definitely going to become over-optimized. And if we adjust the parameters too much, like going from a 20 moving average to a 21, that is also going to cause a lack of robustness and over-optimization. So I'm actually going to show you how to stay away from all of that and make sure your strategies don't blow up on you too quickly. Eventually you'll always need optimization, new optimization, but we can avoid it for as long as possible. And I'll also show you how to know when without using walk forward matrix. So let's say we do have a strategy already picked out and we retested it, blah 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 blah. We want to optimize it. So we're going to do a simple optimization. Let's say, for example, I already got a strategy pulled up. It's already been optimized and it's already been running live for over a year, but just for example's sake, I'll show you how I did it all and we'll go through it right now. So we're going to do a simple optimization. I'm not actually going to run it, but I'll show you how to set up all the parameters and not over optimize it. So the first thing you need to do is know your strategy. You got to go into source code, you got to go to pseudocode, you got to actually look at it and find what the hell it's doing. You want to know it's long. My strategies are always symmetric, so I only got to look at long. The short is exactly the same. So I'll look at this and I'll figure out what its parameters are. So we got the stop loss, we got a break-even rule, and we got a profit trailing rule. That's mainly my focus for right now for optimizing. You can see everything is an interval of 5 or 10 right now. This is interval of 10, I believe, and so that's 5, 15, 4.5, 25. I'll tell you why in a second. I hinted at it a little bit earlier with the moving averages, and this is where it comes into play more. So I want to optimize my stop loss, let's say. So it's going to be a factor of 4.5 as my multiple times an ATR 25. So we'll go into settings. This doesn't matter right now, none of that is set up, ignore that. So we got to find, there's our stop loss ATR and there's our coefficient, our multiple. None of this is set up right now. We're going to set it up right now. The original is 25. Let's say the original was whatever, blah blah blah. Let's say it was like 13. To avoid over-optimization, you don't do it in steps of 1. Let's say we wanted to do 1 to 50. We wouldn't test a 1 ATR, a 2 ATR, a 3 ATR, 4, 5, 6, 7, all the way to 50. That is over-optimizing right there. we want to test larger parameters. Say we'll keep the 50 right there, 10 to 50, and we'll do it at a factor of, let's say, 5 or even 10. 10 would be a robust one, or 5 is still robust. You could even do it by 4 or 3. But if you're doing a step of 1, you're over optimizing. You're looking for such an exact parameter that if the market adjusts slightly, your strategy will stop to be profitable. It'll stop being profitable. So what we try to do is keep the steps large enough so that we're not going for the most precise number. We're not trying to be precise. I know it's counterintuitive of optimization. You want your optimization to be perfect, but at the same time you don't want it to be too perfect. So with stop loss coefficient, I did the exact same thing. I don't know what the original stop loss coefficient was. It might have been like a 3.2, I think. But for this is a much smaller number than what the original was for the stop loss ATR. Coefficients are usually small, and they break them down to the 10th of a digit. So instead of 5 for this, I did a 0.5, and I think the max that I set it up for the stop, where it would stop optimizing it, was like probably a 10, and I probably did like a 2 to a 10, and it tested 0.5. So it did 2, 2.5, 3, 3.5, all the way to 10, and that is basically, in a nutshell, how I stop over optimization. I don't do 0.1 and test 2, 2.1, 2.2, 2.3. That's over optimizing, and the same thing with the stop loss ATR. I don't go by 1. I don't test 10, 11, 12, 13, 14, 15. That's ridiculous. That strategy will blow up tomorrow, next week, next month. It's over optimized. The slightest adjustment in the market and it'll change. Let's say you're trading the Euro USD, you tested it for 2 years, which is horrible. You got to test more than that. Let's say you tested it for 2013 and 2014. This year, the Greek crisis comes into play, and suddenly the Euro USD starts to change a little bit. It starts to range a lot more. That will kill your strategy if it's too over optimized. What you want to do is go for robustness, and that's the name of the game in this video. And even little things actually matter too. And this isn't part of optimization, it's part of generation. And every little part does matter. You want to use as much data as possible, even if you're on a small time frame. And you want to make your tests and your generation as hard as you can on the strategy. You don't want to make it easy, and by that I mean you want to make spread much higher than it is in the real world, and you want to add some slippage. Sometimes there's slippage, sometimes there's not. I put in 1.5, so every single trade has 1.5 slippage. So basically what this does is the brokers that I use for Euro USD usually have like a 0.6 pip spread. So a 2.5 on a strategy really makes it hard. So if a strategy is profitable with a 2.5 pip spread, then I know it's going to be even more profitable when I put it in live trading on my much smaller spread broker. That'll help a lot, actually. Small pips on every single trade over a long time add up to profits or to losses. It depends. Spread widening happens. Massive slippage happens during, let's say, FOMC rate changes. You could see spreads during a rate change sometimes up to like a 20 pip spread, a 25 pip spread, and like a 50 pip, a 75 pip gap sometimes. So what you want to do is make your tests, your spreads, your robustness tests, whatever, slippage, higher than you would even expect in the real world. Because if it passes it now, it'll have an even better chance of surviving in the real world. The real world does not go as expected. Live trading never goes as expected. Live trading never looks as good as it does in tests. That I know for a fact from experience. So let's say we're optimized and now we got this is our chart, and we're gonna live trade it. We put it in the market. We have to know our strategy in and out, so when it's in a losing period, we don't turn it off and make a new strategy, and we don't keep on optimizing it. We have to know when to optimize it as well. So let's say we start our strategy and we just happen to start at a drawdown period. Let's say we start right here, and after, let's say, 20 trades, our equity looks like this. This is not a big drawdown right there. Let's see. This wasn't even, this is glitched right here. Let's see. Yeah, it's not gonna work. So this was probably, I think, my max drawdown was 12.15%. This might have been it right here. So that's only a 12% drawdown. If your strategy in live trading isn't exceeding, let's say a 12.5 or 12.15, then it's fine. It's drawdowns happen. It's not exceeding its max drawdown, max historical drawdown. It's still fine. Normally what I'll do is, let's say we'll use the 12 example again. If market conditions start to change and my strategy, which has a 12 historically, gets a 15% max drawdown in live trading, I'll start to question the strategy. I'll start to question if the market conditions changed. I'll start to question if it's over optimized. I'll start to question if it needs to be re-optimized. If there's nothing that actually hints that the market conditions changed, it could be that I over optimized. Maybe in my testing I didn't use wide enough spreads, I didn't use enough slippage in my tests. There could be a number of things. So those you always want to have, wider slippage than normal and wider spreads than normal. You want to make your tests hard, like I said before. So let's say we did get to the 15% drawdown. I felt like all my tests were good. I felt like the market hasn't changed. Then it might be time for another optimization. But if we didn't hit that max drawdown, then the strategy's fine. It's just in another normal drawdown period. Look, they happens there. It happens here a little bit. It happens here a lot. Happens in there. Peaks and troughs happen. You have to trade the strategy for the long haul, and that's extremely important. So in summary, you want to make your tests as hard as possible by making a little bit wider spreads, adding a little bit of slippage. You want to use extra long data, because if a strategy shows that it survives many years, then it's likely to keep surviving for many more future years. You want to retest on several different data sets. If we're doing the Euro 1 hour, we want to retest on DUCA data. We want to retest on the data that StrategyQuant came with. We want to retest it in MT4 with the brokers data, a couple different brokers data, and after that, if we keep getting like the same good results that it's been showing because we chose a good strategy, then we can gain enough confidence to put it into live production. So in summary, you want to make your tests as hard as possible by making a little bit wider spreads, adding a little bit of slippage. You want to use extra long data, because if a strategy shows that it survives many years, then it's likely to keep surviving for many more future years. You want to retest on several different data sets. If we're doing the Euro 1 hour, we want to retest on DUCA data. We want to retest on the data that StrategyQuant came with. We want to retest it in MT4 with the brokers data, a couple different brokers data. And after that, if all the results were good and pretty similar, they're not all going to be exact, but they should be pretty similar, then it's ready for live production, and we should have a robust strategy that should last a long time. Depends on how much data you used. If you built a strategy on 3 years, expect it to last 1.5 years. If you built it on 5 years, expect it to last a couple years, like 2.5 years. If you built it on only 1 year, expect it to last only 6 months if you're lucky. Or it could be less. It could be 2 or 3 months. But hey, it's your money, your call. So that about wraps it up. It was another half-assed video that I don't really think I outlined anything. I just rambled from idea to idea. I think I covered optimization. I think I got some data in there. How long? Make sure you got long enough. Don't use too little. How long you could expect your strategy to last. When to know to re-optimize when it exceeds your historical max drawdown. What is robustness? What is over-optimizing? Making sure to use big enough spreads. Making sure to add in slippage. And yeah, that about wraps it up. That strategy, that example strategy that I used the whole time, it's been running since the beginning of 2014, and it's returned about 35% since the beginning of 2014 till now, and that's just one of my EAs running. I did a simple retest on it right here with an initial deposit of $1,500 since the beginning of 2014 till now. It returned $561 on an initial deposit of $1,500. It's only risking 1.5% per trade, and its maximum drawdown was only 10%. So if I actually made it risk 3% per trade, that would have been a 20% drawdown. That would be double. It would have returned double. It would have returned $1,120, which almost would have been a 100% return in little over a year on one strategy. That's a robust strategy, and that's a solid strategy, and you can see how good its equity curve continues to work. This is now its 16th year if you add in all the historical tests, because it was tested since 2000. So that's some good shit right there. Good luck. I hope you learned some stuff. Happy trading.